You think an 800 credit score gets you a mortgage? Whether you've ever touched a BNPL service or not, you're already paying an invisible 8% surcharge on products you buy every single day to subsidize $46 billion in phantom debt sitting completely off the books of every major credit bureau in America. Right now, AI systems at major lenders are scanning your bank statements, not just your credit score, and silently flagging buy now, pay later activity like Klarna and Affirm. Even if your payments are on time, even if you've never missed a single one, the real question isn't your credit score. It's what the system thinks you're exposed to, and how long before it starts counting against you directly. I'm Jimmy, and this is Finance Misfires. This is the buy now, pay later scam. Here's something nobody tells you at checkout. When you tap a standard credit card, the merchant pays somewhere between 1.3% and 3.5% in processing fees on that transaction. That's the standard cost of accepting plastic. When a customer uses a buy now pay later service like Klarna or Affirm, that same merchant gets hit with fees as high as 8%, nearly 4 times the credit card rate, which means the retailer is losing almost 1/10 of the total sale price on every single BNPL transaction. Here's the part where you might think, that's the retailer's problem, not mine. Except it becomes your problem immediately, because retailers aren't absorbing that cost, they're distributing it. BNPL services include what's called a no surcharge clause. Retailers contractually cannot add a direct visible fee to BNPL purchases the way they technically can with credit cards. So instead of a visible line item you'd notice and push back on, retailers just quietly raise prices across the board for everyone. The hit gets spread across the entire customer base. Cash buyers, credit card users, everyone. The cost disappears into the broader tide of price increases, and nobody traces it back to the source. Perfect financial shell game. And you're the one funding it every time you buy groceries. So if BNPL is costing merchants nearly 8% per transaction, why do they keep offering it? Because retailers aren't playing for the transaction. They're playing for your psychology, and the return on that investment is significantly larger than a few percentage points on a single sale. A 2024 study analyzing the purchase behavior of 275,000 consumers who used buy now, pay later services found 2 consistent and unsettling patterns. BNPL customers had basket sizes that were on average 10% larger at checkout, and they made a meaningfully greater number of purchases they would not have otherwise made at all. The mechanism is called abstraction, one of the oldest tricks in the financial industry's playbook, and BNPL executes it better than anything before it. When a purchase doesn't trigger an immediate and visible reduction in your bank account, the psychological pain of spending gets muted. Research going back decades has confirmed what retailers already knew intuitively: delay the payment, reduce the pain, increase the spending. BNPL doesn't eliminate that pain. It just delays it far enough down the road that your brain stops registering it as real. So you spend more. You buy things you wouldn't have bought. And by the time the payments hit, you've already moved on to the next purchase cycle. The retailer wins. The BNPL platform wins. You're left more cash than if you just paid up front. Here's where it stops being a personal finance inconvenience and starts being a systemic problem. There are currently 53.6 million Americans using buy now, pay later services. That's more people than the entire state of California making regular purchases on installment plans for groceries, clothing, and everyday consumer goods. In 2024 alone, total global BNPL transaction volume hit $334 billion. Over 25% of American BNPL users have used it specifically to pay for groceries, not discretionary purchases, but basic necessities. And here's the structural problem sitting underneath all of that volume. Because BNPL companies don't operate under the same reporting obligations as traditional banks or credit agencies, the debt people accumulate through these platforms largely doesn't appear on standard credit reports. It exists, it's owed, but it's invisible to the institutions making lending decisions. That's phantom debt, and $46 billion of it is floating through the American consumer economy right now with no paper trail that the major credit bureaus can see. If that invisible debt number sounds familiar in a deeply uncomfortable way, it should. $46 billion, no paper trail, no bureau visibility, and growing. The core failure mechanism of the 2008 financial crisis wasn't complicated. Financial institutions were issuing loans to borrowers who couldn't repay them. When the introductory rates expired and real payments came due, mass defaults followed. The system collapsed from the ground up because the risk assessments were built on incomplete and fraudulent information. Phantom BNPL debt creates the exact same blind spot, just distributed across millions of smaller loans instead of concentrated in mortgage portfolios. A lender trying to assess whether someone qualifies for a home loan or a car loan is working from a fundamentally incomplete picture. They can see the credit card balances, they can see the student loans, they can see the auto payments. They cannot see the $46 billion in outstanding BNPL obligations sitting completely off the books. Same broken logic, different debt type, same invisible risk accumulating in the system's blind spot. And the behavior patterns underneath that debt make the picture significantly worse. Start with what it costs you directly. Average BNPL users carry 4% more overdraft charges and meaningfully higher credit card fees than people who avoid these services. For users pulled in through retailer promotions, the numbers nearly double. In dollar terms, $176 extra per year for average users, up to $252 for more severe cases. Ed DeHaan, a professor of accounting at Stanford, put it plainly, companies that issue credit tend to do so at consumers' expense when the regulatory environment allows it. The data confirms exactly that. Now zoom out to what it's doing at scale. Economists have identified a practice called stacking, where consumers carry multiple simultaneous BNPL loans across different platforms, often losing track of the total amount owed. The Consumer Financial Protection Bureau found that 63% of BNPL borrowers had simultaneous active loans at some point, and 33% were carrying loans across multiple different platforms at the same time. That's not a handful of financially stressed individuals. That's the majority of users operating inside a debt structure that no single institution has full visibility into. Wells Fargo economist Tim Quinlan estimated BNPL spending reached approximately $46 billion in 2023, with no meaningful signs of deceleration. Nearly 30% of U.S. consumers have used these services at some point. The core user base skews younger and lower income, the demographic least equipped to absorb the consequences when the math stops working. The debt bubble is expanding in the dark, and the big three credit reporting agencies, Equifax, TransUnion, and Experian, are operating with virtually no visibility into it. Here's the part that makes this genuinely predatory rather than just poorly designed. BNPL services don't require a credit check. You can have a documented history of defaulting on loans and still qualify for a new installment plan on a Tuesday afternoon at checkout, which means these platforms, by structural design, are most accessible to exactly the people most likely to struggle with repayment. And now that debt is coming for your mortgage. Here's where the phantom debt stops being invisible. As of 2026, underwriters have begun incorporating BNPL payment history as a direct factor in credit scoring assessments. And they're not doing it manually. AI underwriting systems, now analyzing bank statements automatically, are flagging BNPL activity, even when it doesn't show up on a standard credit report. Your FICO score, the number that determines approximately 90% of all lending decisions in the United States, according to Investopedia, is now being influenced by behavior that most Americans assumed existed in a consequence-free financial zone. And the delinquency trend underneath that scoring shift is accelerating in the wrong direction. LendingTree's tracking data shows the delinquency rate climbing every year: 34% in 2024, 41% in 2025, and now 47% in 2026. Nearly half of all BNPL users made a late payment in the past year. The trajectory isn't improving. It's compressing. When AI flags these delinquencies during a mortgage application review, the consequences are direct and immediate. Because the question an underwriter is effectively asking is brutally simple: if this person couldn't manage a $200 grocery installment plan over 6 weeks, what happens to a 30-year mortgage when something goes wrong? The mortgage industry has started saying this out loud. Waterstone Mortgage has explicitly warned borrowers that overuse of BNPL services could negatively impact mortgage approval or delay closing entirely, and that anyone planning to go through the approval process should think carefully about opening new BNPL accounts or increasing usage frequency. But the AI flagging is only the first hit. The second one is your debt-to-income ratio, and it's arriving with no warning. Your debt-to-income ratio, all monthly debt payments divided by gross monthly income, is one of the primary determining factors in mortgage qualification. Previously, BNPL payments were invisible to this calculation. A borrower could look financially healthy on paper while carrying significant monthly BNPL obligations that never showed up in the DTI assessment. That's changing. As BNPL payments get factored into DTI calculations, borrowers who appeared to qualify comfortably are finding themselves pushed above the 43% DTI threshold that mortgage lenders classify as high risk, triggering automatic rejections on applications that would have sailed through 18 months ago. Not because their financial situation actually deteriorated, because the calculation finally caught up to reality. This is what happens when a product gets built with a move fast and break things tech mentality and dropped into one of the most consequential financial decisions an American family will ever make. The convenience gets sold up front. The consequences show up years later, quietly, automatically, and often without any clear explanation of why the rejection happened. Zoom all the way out, and the BNPL story stops being just about installment plans and starts being about a broader structural direction. Morgan Stanley has flagged BNPL as a potential masking force, a mechanism that makes the true scale of consumer debt impossible to measure accurately. When $46 billion in active debt sits outside the visibility of the major credit bureaus, every risk assessment in the lending system is operating on incomplete information. Deep subprime consumers account for 45% of all BNPL loans. Another 16% comes from subprime borrowers. Heavy BNPL users carry an average of over $22,000 in total unsecured debt, with BNPL representing only 17% of that total. BNPL isn't replacing existing debt, it's layering on top of it, showing up in the financial lives of people already stretched, making their situation measurably worse while keeping the damage invisible to the systems designed to catch it. The 2008 crisis happened because the system was pricing risk it couldn't see. This is the same movie. Just smaller loans, more borrowers, and no single moment where the alarm goes off. There's no single moment where buy now pay later tips from a convenient consumer tool into a systemic problem. That's exactly what makes it dangerous. It builds slowly, quietly, until the DTI calculation changes, the AI flags the account, and the mortgage rejection arrives with no explanation attached. If this changed how you think about that checkout button, drop a comment telling me whether you've already run into BNPL activity affecting a loan application, because I guarantee you're not the only one. Share this with someone who uses Klarna or Affirm and thinks the payments being on time means they're in the clear. Subscribe Finance Misfires for more breakdowns like this. The financial mechanisms operating just below the surface of everyday American life until they suddenly aren't. I'm Jimmy. You didn't miss a payment. The system just started counting things it used to ignore. I'll see you in the next one.